And sorry for minutes delay for technical reasons. I'm Nicolas Veron. It's my pleasure on behalf of the Peterson Institute to introduce this session with Secretary of State Jörg Kukis and Climate Counselor John Morton, and we'll discuss sustainable finance and policy coordination for sustainable finance in the transatlantic space between Germany, the European Union, the US, but also at the global level. Jörg, let me introduce briefly our two speakers today. Jörg Kukis is the Secretary of State State Secretary for Financial Market Policy and European Policy at the German Federal Finance Ministry in Berlin, from where he joins us today. He actually studied in Paris at Panthéon-Sorbonne universities and in the US at Harvard Kennedy School, where he got his master's in public administration in 1997, and at the University of Chicago, where he got a PhD in finance in 2001. And after that, Jörg spent almost 2 decades at Goldman Sachs in London and Frankfurt again from 2001 to 2018, working in equity derivatives, for which he had responsibility for the whole Europe, Middle East, and Africa region. He was, if I understand the Goldman Sachs titles correctly, basically the head of the German business. And from there, joined the Federal Ministry of Finance in April 2018 in his current capacity. John Morton also has a very distinguished and very diverse career. He studied at Harvard and I think Russian history and literature, if I'm correct, John, and then worked at the World Bank, at Mercer Management Consulting in the 1990s. Then got simultaneously, I think, an MBA at Wharton and a master's in economics at SAIS Johns Hopkins, both in 2002. And he was an investor in the Global Environment Fund, so already an indicator of current topics, but also director for national security in the John Kerry campaign in 2003-2004. And then worked at the Pew Charitable Trust, which is a major think tank and foundation here in the US, managing director of economic policy in 2005-2006, and then at the Overseas Private Investment Corporation, which is now the International Development Finance Corporation of the United States, as senior director for energy and climate change in the later 2000s. He was senior director for energy and climate change. My notes are confused at the National Security Council, then in the Obama White House, and during the Trump administration worked at different think tanks, Mercator Foundation, Atlantic Council, European Climate Foundation, and most lately at the consulting and investment firm called Pollination, which is a global firm focused on the fight against climate change and the transition to net zero. John was appointed in April as the first climate counselor on the Treasury, and I read the communications the Treasury published that day on April 19. As climate counselor, he will lead the Climate Hub, report directly to and advise the Secretary, Janet Yellen, on a broad range of climate matters and focus in particular on Treasury's efforts to facilitate and unlock the financing needed for investments to achieve a net zero economy at home and abroad. So we couldn't dream of a better combination to discuss international policy coordination in this area of sustainable finance. And with that, I give you the floor, Jörg. I think you have a few slides. Over to you.
Thank you. So first of all, many thanks to the Peterson Institute for reaching out and the invitation to today's financial statements. I'm very happy to be able to share views on different aspects of sustainable finance, and of course, looking forward to the discussion with yourself and John Morton and all of these topics that, of course, are becoming more and more relevant and more important to the public debate. I think we all agree that in order to address the climate issues that we have and all of the questions of sustainability, we will need a very substantial amount of both public and private sector investments. So steering these investments in the right direction while at the same time managing the transitional risks will be very key and very central to our success. So in that sense, I think it's very topical that we speak about the objectives of sustainable finance on the one side to manage risks from the transition of our economic systems to a more sustainable future. From our perspective, risks can come from a variety of directions. Of course, one of the things that we are looking very closely at in terms of banking supervision is the issue of stranded assets. That will potentially lead to devaluation in the long run because demand slowly but gradually declines with changes in the inevitable regulation, increasing costs of emitting CO2 that leads to changes in production processes and consumer preferences. Of course, oil fields are one of the most prominent examples of this. We saw recently a substantial revaluation, for example, of BP's balance sheet in this sense because of the need to correct long-term price assumptions, but that's only one case of many. Of course, we see a lot of adjustments of business models that rely on cheaply sharing negative externalities like clean air, with the increase in mechanisms and broadening of emissions trading systems to price carbon emissions correctly and to internalize the externalities. I think that trend will only grow and different business models will become profitable or not profitable depending on the willingness or ability to cope with the transformation in an appropriate way. The second objective, in addition, of course, to internalizing these externalities, is to enable the shift of investments from unsustainable to sustainable economic activities. Of course, that will require a massive amount of capital. We can see that in Germany, as we move away from nuclear energy into renewables, we can measure very precisely how much every move costs. We are now moving away from coal as well into renewables. So in that sense, we can quantify the cost of that pretty precisely. We all know the numbers from the IEA of $5 trillion annually required investments to achieve the transition to sustainability only in the energy sector. So I think it's very obvious that we need to mobilize not only public funds but also private funds to facilitate that transition. And of course, the financial sector will be key in facilitating that shift and to support the massive amounts of investments that are required, and at the same time, of course, leverage their risk management capabilities to also manage that transition and steering capital into the right direction. That, of course, is not only a challenge, not only a cost, but also a very substantial opportunities. And we, as governments and supervisory bodies, of course, will have the task of monitoring that and setting the right incentives to facilitate that. What the German government is doing in this context in the sustainable finance strategy is quite comprehensive. On the one side, we implemented a very ambitious climate change program. On the other side, we said we need to balance that with a sustainable finance strategy that will allow us to fund the programs that we're trying to build. We set up a sustainable finance committee already in 2019 with membership coming from civil society, coming from the financial industry, and coming from the producing industry. That I think is important to have a good balance there. We have come to a conclusion of that process just in time for the end of the term of the current government, and have received a very comprehensive set of recommendations with overall 26 measures. Just as an overview, some of the key items that were identified in that process by the Sustainable Finance Committee is first of all to use what we are doing in the federal government as an important signaling device, both to markets and investors. On the one side, we in that process quite successfully issued green bonds to the financial markets and received a very, very substantial increase in volumes. We broadened our investor base of our government bonds, and on the other side, also incentivized existing investors of our government bonds to diversify into the green bond space, and therefore give additional liquidity and additional credibility to the green bond investment case. So I think that's important. What for us as a finance ministry is a nice add-on is that it turns out that green bonds trade at what's called a greenium, i.e. investors pay a higher price for the identical green bond relative to the classic bond with the same tenor and the same interest rate. So in that sense, it's also good from a pure fiscal perspective, and that is always important in Germany. Additionally, we've changed the investment philosophy of our government investment funds. They are all going onto a climate transition benchmark, which was recently introduced by the EU. So in that sense, also to the extent that the German government is an investor, we're also putting our money where our mouth is in terms of the investment allocation decisions that we're doing. On the other side, as a second measure, we of course identified transparency as a key metric towards driving the financial industry in the direction of green. It's extremely important, and that's the constant feedback both by institutional and retail investors, that they want to be sure that whenever a product is labeled green, they also want to be sure that what's inside the product and where their money is going is actually green. So in that sense, it's extremely important that we support the investment made by the European Union to come up with a credible taxonomy of what is categorized as ESG, and there, of course, environmental is the first big project. On the other side, what we are doing, incentivized also by our Sustainable Finance Committee, is to come up with sort of a retail-friendly traffic light of what fulfills the requirements. Of course, risk management is a third very important aspect of this, and our Sustainable Finance Committee agreed and prioritized this very highly. We will strengthen our financial supervisor, the BaFin, to engage in scenario studies to cover specifically physical climate risks. We are in full agreement with the European supervisory bodies that this should become a European initiative that also levels the playing field, so that those who engage in sustainable finance funding don't suffer any kind of competitive disadvantage to the other regions in Europe. So I think that's important. Data quality reporting is extremely relevant and extremely crucial. So that's something that we are also bringing to the forefront. The European level, of course, is extremely important in this. The European Union identified sustainable finance as a key topic already in 2018 and is becoming a very important standard setter. I mentioned the taxonomy earlier, but the whole action plan financing sustainable growth, of course, is a very, very strategic project that completely ties in to the Green New Deal of the European Commission. So in that sense, I think it's very important that the Next Generation EU financing instrument is used as a lever to massively go into public investments into the green economy, and also into reforms that will encourage investments on the private sector into greening the economy and achieving our very ambitious European climate goals. So I think that the fact that fiscal policy is completely in sync there with what we're trying to achieve in green finance is extremely important. Of course, all of the upcoming revisions, for example, of the MiFID review should also make sure that the incentives that individual member states are giving to encouraging advice, financial advice, to also take into consideration sustainability aspects should be harmonized across the European Union. So I'm quite convinced and optimistic that both nationally and at the European level, we're gaining traction on this topic. Many thanks, and look forward to your questions.
Thanks so much for the scene setting, and of course we want to emphasize particularly the comparison with the US and the prospects for international cooperation beyond the transatlantic space. So on this, John, over to you.
Thanks very much, and I want to start by thanking the Peterson Institute for inviting us, inviting me today to participate in this conversation, and also thank Jörg Kukis for his compelling overview of the German actions on climate and sustainable finance more broadly. I think your strategy reflects a vision that we share and a belief that we share about the immensity of the challenge and the immediacy of the challenge in front of us, but also about the tremendous economic opportunity that's embedded in the transition to a low carbon economy. I think it's worth highlighting here, obviously, President Biden fulfilled his promise to rejoin the climate world and the climate conversation by rejoining the Paris Agreement on day one. And we are now working actively with friends and allies to encourage greater global ambition, while benefiting from the critically important work of international partners that took place while the US was sadly absent from the climate conversation, at least at the federal level, in recent years. We believe that the next decade will be decisive. The steps that countries take this year to set the world up for success will make all the difference to protect livelihoods around the world and to keep global warming limited to a 1.5 degree Celsius target within reach. We have to get on the path now. And we also believe that the countries that take decisive action now to create the industries of the future will be the ones that reap the economic benefits and create the jobs that power the economy for the decades ahead. We are very grateful and appreciate the EU's ongoing engagement with the Treasury and the US regulators on climate change and sustainable finance through our bilateral financial regulatory reform processes and across a number of multilateral forums, including directly with our German colleagues at the Financial Stability Board and the G20 Sustainable Finance Working Group. So let me just give a little overview of what we're doing at Treasury, where we are focused on a broad range of climate-related domestic and international policy work connected to climate finance, climate-related economic and tax policy, and climate-related financial risks in the financial markets. We're focused on mobilizing finance for climate mitigation and climate adaptation, and supporting the broader alignment of the financial system with a path to net zero emissions by mid-century. And as part of this strategy, we've created a new climate hub, which Nicholas, you alluded to, which I'm honored to lead. The climate hub will coordinate and enhance our existing climate-related activities by harnessing the tools and the capabilities and the expertise from across the department, enabling us to move more quickly and nimbly in prioritizing climate action. We are also looking to do more with our existing multilateral tools. We look forward to identifying new, innovative, and impactful programs in the multilateral climate finance sphere. Efforts like the Accelerating Coal Transition Program at the Climate Investment Funds, we believe, represent a new way of thinking about how to utilize public funds to catalyze private capital to address important issues like the repurposing of existing coal facilities in fast-growing emerging markets around the world. We're also soon to release our approach on fossil fuel energy activities at the multilateral development banks. And so while we are transitioning to a greener economy here at home, we will be advocating for the MDBs to help developing countries shift more quickly to clean energy and away from carbon-intensive fossil fuels. And we'll be directing the US executive directors at the multilateral development banks to work with partners to ensure that these institutions implement ambitious climate finance targets and policies to support additional private sector financing for high quality infrastructure development that incorporates economic, social, environmental, and governance standards. A couple more things I'd like to say related to the climate finance plan that the US government released last month at the Leaders Summit on Climate Change. It's the first of its kind in the US at least, and it focuses specifically on international climate finance that leverages the expertise and resources across multiple agencies. It provides the US government with a strategic vision of international climate finance out to 2025 and signals to other governments, institutions, and stakeholders that the US intends to work closely with them to deploy climate finance more efficiently and with highest impact. We focus on 5 areas: scaling up private climate finance and enhancing its impact, mobilizing private sector finance, taking steps to end international official financing for carbon-intensive fossil fuel-based energy, making capital flows consistent with low emissions, climate resilient pathways, and defining, measuring, and reporting on international climate finance. And as part of this plan, we've announced our intention to double by 2024 our annual public climate finance for developing countries compared to what the US was providing during the later half of the Obama administration. The International Climate Finance Plan also conveys Treasury's renewed commitment to working with our partners internationally to better coordinate approaches to facilitating climate-aligned finance. We believe, obviously, as Mr. Kukis does, that financial institutions play a critical role in facilitating the transition to a low-carbon economy. And so a key priority of Treasury is to help financing institutions make informed decisions considering the climate risks they face and the market opportunities associated with the transition. As part of our international efforts in this area, Treasury is pleased to co-chair with China the G20 Sustainable Finance Working Group, an important forum that we believe will help and is helping now coordinate a global approach to scaling up finance to help address climate change and other great sustainability challenges. This year, that group will develop a sustainable finance roadmap with an initial focus on climate. And additionally, the SFWG, as it's known, will work to identify ways to further advance sustainability disclosure and reporting, improve compatibility of approaches for identifying climate-aligned and sustainable investments, and accelerate IFI's support for the goals of the Paris Climate Agreement. I want to call attention to something that happened last week, which is that the President Biden issued an executive order on climate-related financial risks, which lays out actions across the government that the government will be taking to measure and mitigate climate-related financial risks. The steps in this executive order will ensure that government programs account for these risks, protecting taxpayers while providing information to help plan actions that benefit climate and the economy. Under the executive order, the Treasury Secretary, in her role as chair of the Financial Stability Oversight Council, or FSOC, will engage with financial regulators to assess data gaps, assess the role of climate financial disclosures, and identify tools to measure and mitigate climate-related financial risks in those institutions. And we will be working across the US government to develop a comprehensive strategy that takes into account climate-related financial risks, the financing needs to support our 2050 net zero goals, and identify areas where public and private financing can come together to meet those needs. We share the view that Mr. Kukis put forward that good risk measurement and proper regulation is absolutely critical to aligning investor incentives and to limiting adverse spillovers of climate risks through the financial system. And our work in this area will build on important work in this area that has taken place internationally. And we're looking forward to becoming a leader in this area rather than a follower, as I think we have been in recent years. The last thing I'll say is just to call attention to the importance of legislation that we are actively working on currently with Congress, the American Jobs Plan. If you want to see the administration's commitment to the transition to a low carbon economy in this country, I think you need to look no further than the actions and the proposals that are in the American Jobs Plan. Climate change is recognized as both an existential threat, but presenting an economic opportunity for our country as we drive the transition to a low carbon economy. And we respond to this challenge by investing in new energy infrastructure, supporting research and development that will incentivize innovation in new clean energy technologies. We believe this transition to a greener economy will provide a multi-decade boost to the economy, creating jobs along the way as private sector participants join in the development of new technologies, new investments, and new products that will drive the global economic transformation. Thank you very much to CSIS for the opportunity to participate in this event, and I look forward to
the Peterson Institute. It will be today, but
I'm sorry. The Peterson Institute. Excuse me.
No problem. And we say hello to our peers at CSIS on this occasion. They also do interesting stuff. I am struck by the multiplicity, of course, of decision makers, and indeed the title of our session is about coordination. Jörg, John mentioned the coordination with China and the Sustainable Finance Working Groups that the US is co-chairing. Can you give us, there is a very fast-moving debate in Europe right now in terms of how to engage with China or what kind of stance to adopt. Can you give us a sense of where things are moving in the European debate and specifically the German debate in terms of this aspect of cross-national and global level coordination?
Yeah, well, I think just looking at the numbers of where the CO2 emissions are taking place, I think it's needless to say it's absolutely urgent and necessary to engage with China on this topic, and we're therefore very happy that John and his team are very much engaged there. So I think it's apart from all of the issues that we're having and discussing at the global level, I think it's needless to say that we have to stay very closely connected and very engaged in all global fora with China on this topic. So I think there's definitely a lot of consensus in Germany that for this topic, if we want to succeed, we have to engage with China.
Do you have the feeling that this view is reciprocated in Beijing?
Well, yeah, I mean, as John pointed out, there is the willingness to work together. Of course, I think it's very normal and something that the topic that will always come about is that the economies that have very high per capita BIP have to accept that the transition path is a bit different in other regions of this world. So in that sense, I think as long as we accept some of the basic facts, there will be a reciprocal advancement in this area.
John, back to you on this issue of the relationship with China. It is indeed very notable that the Biden administration has decided to engage in a dialogue with China on climate change. But as we know, Congress, and this is not particularly a partisan issue, Congress is very skeptical of any cooperation with China at this point. So how are you going to juggle those constraints? Assuming that at some point there is a need for legislation or congressional approval for any of those initiatives that would come out of the cooperation with China, is it something that you think is feasible in the current US institutional and political environment?
Thank you. So look, I think if you look historically, the U.S. and China have actually forged a quite constructive, extremely constructive relationship on climate. If you look back to 2015 and the deal that was struck between the leaders in 2015, that really paved the way for, I would say, the most significant climate actions that took place between 2015 and the end of the administration, culminating in the Paris Agreement not just being signed but entering into force in a very, very short period of time. That was based upon a lot of shuttle diplomacy between Washington and Beijing, much of which I had the privilege of being part of. I think that the climate relationship with China has always been, and I think it's fortunately so, somewhat separate from the broader geopolitical discussions and debates that we have on many, many other issues. And I think the cooperation that we see now with the Chinese on the Sustainable Finance Working Group is another indication that we can continue to forge forward on this collaboration while in the midst of deeper conversations on other matters. I think also that to the extent that the U.S. and China are able to make, as we are making now, progress on some of these underlying issues of disclosures and reporting, if we can carve an agreement between ourselves on the frameworks for how that should look, that provides a lot of space for an agreement to be reached in a broader fora. So I think we're very optimistic. I think those conversations are occurring frequently and often in a very positive manner. And so I see that track as something that will be a strong point of our relationship.
So if I hear you correctly, there's a willingness in the Biden administration to kind of ring-fence the climate conversation from other current issues in the bilateral relationship with China. But what you imply is that there is the same willingness to ring-fence on the Chinese side. Did I understand that correctly?
Well, I can't speak for the broader agenda. What I can say is that within the context of the Sustainable Finance Working Group, those conversations are productive, ongoing, and we see them as a big addition to an extraordinarily necessary agenda this year, which is around beginning to forge agreement on standards, reporting, disclosures, and all the things that are really going to make markets move ultimately, and provide the certainty and the clarity, and ultimately some form of baseline harmonization that will be required, I think, to unlock the trillions required to get us to net zero.
I also have a clarification question before moving on to feedback from the audience. But you mentioned, John, that part of the plan from the Treasury perspective was to make capital flows consistent with the federal government's climate policy, if I heard you correctly. Can you elaborate on what you mean by that?
Maybe you could ask the question one more time so I make sure I'm answering the question.
I heard you saying we want to make capital flows, cross-border capital flows, consistent with our climate policy goals. That was part of your 5 items on private finance in terms of the current outline of your stance at the Treasury. But maybe I misheard. So I was just intrigued by the mention of cross-border capital flows in that context.
Yeah, no, I think the point I was saying is the fourth point in that plan is making capital flows consistent with low emissions, climate resilient pathways. Those are capital flows that are occurring within our country or cross border, and I think the administration has made it clear the direction of travel that we are moving in with respect to both the addressing the challenge side of climate change and the need for investor protections. With respect to financial disclosure, that's an issue that we're looking at carefully. That's the challenge side. On the opportunity side, again, we are framing this appropriately as a transition which should be of significant economic benefit to those industries and corporations and governments that take a stronger posture on this transition. And so making capital flows consistent with our net zero target of 2050 is a priority of not just the Treasury Department, but the broader administration.
Thanks for that clarification. Jörg, I have a question on the Q&A from Ben Rattenbury, who alludes to recent reportings that the German government is blocking G7 agreements on mandatory reporting according to the task to the TCFD, the task. I'm bad at acronyms. You know the TCFD. So the question is, what are the main concerns here for Germany? Can you give us a sense of what the nature of the conversation is, and what would be needed to get this agreed?
Yeah, I mean, I think we agree on the ultimate goal of opening up the reporting and making sure that investors have a clear view of the climate impact that our corporates have, and all of our corporates are already doing quite a lot of that on a voluntary basis. I just think it's important to have a synchronized approach on this, and as you know, the European Union has some legislative proposals on this. So I think as long as we do this in a synchronized and harmonized way, I think we're in good shape. And the other question, of course, is always the institutional setup, and how do we make sure that that there is a public endorsement and public control of the decisions that are being made in reporting, because of course, due to the public good nature of climate change and all of the instruments that we're using to promote climate change, of course, it's important to be cognizant that whoever we delegate this task to is also responsible and takes into account the public good nature of specifically climate-related financial reporting.
Well, but
on a good track. I don't see a huge amount of controversy there, so I wouldn't characterize this as blocking. I would just say it's a collegial discussion. So I think it's on a good path, though.
I didn't train as a diplomat, but the question I hear a lot is this question of how to set the norms or standards or whatever the vocabulary is, and this trade-off in a way in trying to achieve globally consistent standards, which will achieve what you just mentioned, a level playing field, or having more of a handle on the standard setting and being able to set the bar high enough. And I understand that in Europe, this is a trade-off which is very much live in terms of European standards versus achieving alignment with whatever global standards which currently don't really exist. Can you give us more of a sense of this trade-off and what kind of, I mean, the European Commission obviously has taken the lead with the announcement of the taxonomy. Now we see that publishing the taxonomy is not easy. And can you give us a sense of this, how to manage the aspiration for global standards versus the aspiration for mastery at the EU level?
Yeah, I mean, I think the debate around the taxonomy is an extremely good example for my basic theory that we shouldn't be naive about this topic. There is no objective way to say that activity A is good or bad. This is always going to be driven by preferences. And just the debate that we're having within the taxonomy on the absolutely crucial item of energy just shows you that that this is all about political interests, and we have to find a balance there. So
wait a minute. What you're saying now is completely depressing, right? You said there is no objective reason to achieve that taxonomy. Isn't this about confident science?
I'm saying is when I talk to my French colleague about the impact of nuclear energy on a sustainable energy mix, the views that the German government has is diametrically different to the one the French government has, right? The French government says that they weight the CO2, the lack of CO2 emissions highly. The German government says we weight the massive risk of accidents happening and the unresolved sustainability of clearing up the nuclear waste as the clear detriment to sustainability. So what I'm saying is the question of whether energy type A, B, or C is sustainable is not a objectively measurable item that is completely distinct and remote from a political debate. I think that's just where we have to be realistic. And that's, if you look at the taxonomy and also the debate with some member states on coal, on gas, I think that just illustrates to you that we shouldn't dream of this being just a sort of pure science-based objective world. Of course, political decisions have to be made whether we within a mix of energy types ascribe different weights to different risks.
John, if France and Germany cannot get their act together, is there any chance of international cooperation?
Yes, there is, and it's ongoing, and it's active, and there's pressure both from governments and, frankly, from the finance sector. I mean, look, we're in a position, a fundamentally different position now from where we were 3 or 4, maybe even 2 years ago. So over the last even several months, we have a continued drumbeat of large financial institutions announcing net zero commitments and strategies, right? And these commitments are sending, I think, a powerful signal to policymakers and global financial markets that private capital is prepared and ready to support this transition, but needs more guidance. So we are both driving ourselves as policymakers in one direction and getting pressure from financial markets for clarity and consistency. And I think we believe that this is a process which does not need to drag out for a long time, but needs to drag out in a way that that incorporates the needs and the timing and the different governance structures within large countries, ours included. So, for example, as you probably all know, the SEC right now is in the process of revisiting its 2010 guidance on climate-related financial disclosures, and there's an open comment period right now where it is accepting input from the market with respect to how it should treat and prioritize and potentially require further mandatory reporting. That question needs to play out within the context and the process of the SEC's independence and its own timing, but it will play out this year, and it will play out quickly. We believe, in terms of the kind of harmonization question, that the combination of the Sustainable Finance Working Group and the work that's happening there, and we believe the International Financial Report Standards Foundation, or the IFRS, represent a good opportunities for us to carve what would not be a single high-level set of thou shalt, thou shan't type standards, but rather building blocks that establish a base level for certain reporting, and then can be built on with additional standards over time. And we see that as probably the most likely way that this process will evolve, over the next year or two.
So that's the new sustainability reporting standards boards at the IFRS Foundation, the foundation that covers standard setting for international financial reporting standards, is going to set up in the next few months, right?
Correct. And
Jörg, there have been a number of discussions about this in Europe, and whether, Europe, of course, was in the lead in adopting IFRS 2 decades ago and making them an accounting standard for the world, except the US, by the way. But there is, I sense a little bit of reluctance in Europe to have the same amount of delegation of standard setting to the IFRS Foundation in sustainable finance as there has been in accounting standards. Can you give us a sense of the current thinking, both in Germany and then in the other member states at this point on this issue? And I will add a question which is asked on the Q&A by Marianne Nessen, which is, it's becoming a crowded place in terms of addressing climate change and setting standards. How to avoid too many initiatives leading to inefficient processes?
Yeah, I think the public good character of accounting standards in general is beyond dispute, but I think the additional importance of the public good quality and aspect of financial reporting standards for sustainable finance, for climate issues, additionally, because climate is such an incarnation of a public good, and the reporting about it has even stronger public good characteristics. So I think the question of, can we delegate the decision-making process, and as I said, there is no objective right or wrong in this process, to a private institution that lacks democratic control, of course, is an open question. And if we do, how do we make sure that the policy issues that we have and the directives that we have of channeling investment into this direction are met by the standards set by a private board? Of course, I think are a highly relevant question. As you know, the EU has standards for approving IFRS standards, and of course it should be an intensive debate around whether those that work for pure financial reporting also work for a much more policy-driven object of reporting, such as the impact on climate. So I think that's a totally normal and legitimate discussion that we're having across Europe.
So I sense a little bit of an almost counterintuitive pattern here, which is in accounting standards. And sorry to draw the parallel, but we're talking about the IFRS Foundation, so it comes quite naturally into the discussion. In accounting standards, Europe has really been the champion of global harmonization, and the US is the main jurisdiction that hasn't adopted IFRS, at least so far, except only for foreign issuers in the US. Conversely, what I'm sensing now from this discussion and others is that the US is more of a champion of the role of the IFRS Foundation in establishing the building blocks for sustainability reporting, as John just put it, than the European Union is. Is that perception inaccurate, Jürgen, John?
Look, I would say that we see the IFRS Foundation as a productive institution for us to consider as we grapple with this question that you're outlined very nicely of how and where and what do these standards and building blocks look like. And I think our view is that the IFRS Foundation at this point appears to offer the building blocks to be a productive player in this conversation. Is that a final policy position? No, but I think it's an indication of where we see potential opportunity for further discussion. And I would agree with Jürgen entirely. These are the types of things that one discusses as one is trying to figure out how to coordinate and manage global financial market standards. So it's natural for us to be having this conversation at this point in this process.
Jörg?
Yeah, I think it's very natural, as John said, to have these debates early on in the process. So in that sense, I don't think it's in any way, shape, or form concerning or worrying or anything that the political decision makers, as they make this very impactful choice of where to put this responsibility of for reporting standards, evaluate all options and think about all versions and pros and cons of each of them. So in that sense, I'm much less concerned about the fact that we're having these debates. That's just part of the normal democratic process, I would say.
There's a question from Thomas Ray about the venue for global cooperation, and he's asking, it's clear that some norm on green investment is needed, but is COP26 the right venue to try and reach an international norm for green investment, or should it be done through the OECD or another organization? I have to confess, I'm a bit lost, like others, given the multiplicity of current initiatives, also the private sector initiatives that in many aspects have taken the lead on some of those discussions. So can you give us a little bit of a sense of how you juggle these different formats of discussion, also frankly the G20, and how you see the architecture of global discussion at this particular point of time? Maybe Jörg first and then John.
Well, as long as we don't have a global parliament that sort of concentrates all of these discussions, I think it's just a fact of life that we'll have different fora of discussions. You didn't even mention the FSB, which also, as John pointed out, we're having quite a lot of intensive discussions on this topic in that as well, and all of the multilateral financing institutions are active there. So I think the multiplicity. I'm actually, given that everyone is talking about or was talking until recently about the crisis of multilateralism, I think it's a quite luxury problem, I would say, that we now have the impression that we have too many international fora engaging on this topic. I think, I agree, of course, at some point you have to come to terms, and if there's too much of it, then you could have contradictory results. But I do think, stuff like the fact that we are now in the final stretches of agreeing on a taxonomy in the European Union, that will also drive a discussion at the global level, which parts of that taxonomy can you use or not, because of course, US investors, Asian investors will react to the EU version of the taxonomy, And then other regions of the world may say, you know, it's pretty good. It would be pretty good if we had a global standard on that. And then I'm less concerned whether COP26 or the G20 or the G7 is the right forum. I think these things are so big and so complicated that a consensus will emerge no matter where we choose the final decision making to be.
So having all these simultaneous discussions is in a way to get to a decision making rather than competing environments, right? That's the picture you're painting.
Well, I mean, if you look at the last the last G7, G20 combinations, right? I have to say I'm utterly happy that we now have too many of the international fora discussing these topics. Than a whole year where we had essentially in both the G7 and the G20 almost no discussion about these topics because both respective presidencies chose not to put this on the agenda so highly, right? So in that sense, I think, as I said, it's more of a luxury problem if we have too many.
No such thing as too much of a good thing. John?
I echo those comments. I would just say, you know, when I was in the Obama administration, certainly in the early years, if you were looking to have a climate-related deliverable of some sort, you kind of thought about it and you put it in like the COP bucket. You know, it's like we'll get to November and that's when we'll be discussing this issue. And then you had some deliverables, and then people went back home. And we're at a point now where we this government, and I'm sure Germany as well, thinks about, okay, how does the G7 create momentum that leads into the G20, that leads into the, you know, further in the year, and we think strategically about how do we advance our policy priorities through that process. And climate is central, not just for this administration, but increasingly for every G7 and G20 country. So I don't see it as a problem. I see it as a good thing. And I think we proved last month that if we want to create a new climate moment with, you know, the President Biden pulling folks together, you know, there's appetite for that as well if needed. So I'm optimistic about how frequently this issue is being discussed and acted on as well.
So we have a number of questions about the political realities in the US, and I'm sorry for those who asked about carbon border adjustment and putting a price on carbon and that kind of issues, because they're not really the focus on this session, even so they're very salient, of course, more generally in the fight against climate change. And the Peterson Institute actually will organize more events shortly about these issues, including the difference between the EU stance on carbon border adjustment mechanism and what appears to be the current stance of the Biden administration. But let's skip that for now. And John, I have a number of questions about the political environment. Ben Rattenbury is referring to the fact that states in the US, including those run by Republicans, have authority over some aspects of financial regulation. So could they thwart the initiatives that the federal government and federal agencies could take in terms of driving finance towards more net zero objectives? He mentions initiative by the Texas state legislator to block banks from cutting ties with the gun industry. So could you have something similar with climate? Greg Smith is asking a similar question about the Federal Reserve. If the Federal Reserve goes into more climate action, could that generate a backlash in Congress from the Republican side? And Paresh Patel is asking again the same question about the projects about, you know, proposed national green bank or the action of U.S. authorities, agency authorities like the Exim Bank to go more towards climate net zero action. How is the Biden administration going to? I mean, I know the question in a way is more general, but how is the Biden administration going to manage all these political tensions given the current situation in Congress?
So these are all good questions and ones obviously that we think about all the time. I guess in the short time that we have, I'll answer at a fairly high level and say, you know, again, 10 years ago when we were doing climate-related policy in the last administration, we were facing a different economic and financial market demand. than we are today, in the sense that ESG investing, sustainability investing, climate-related investing, net zero investing, Paris-aligned investing were not things that investors were talking about. They may have been scratching the surface and beginning to think about it, but they weren't talking about it. And they certainly hadn't made multi-trillion-dollar commitments to align their portfolios, as we now see. So I think the answer to that question is, of course, there will be states and legislatures, federal and at the state level, that do things to try to block policy actions. That happens for all sorts of reasons, and climate change, unfortunately, in this country is so heavily politicized, and that's a pity. I think what will keep this momentum moving is the fact that the financial sector understands the necessity of this transition, sees it both as a huge threat from a stranded assets perspective, but also a significant opportunity from a green growth perspective. And I think that will give us the flexibility and the support we need to be more forward-leaning with respect to financial market guidance. So that's my optimistic hope on where we are.
Jörg, I know you're time constrained and we want to finish on time, but maybe a last question. We hear also progress that has been made in a small number of years, even compared with the end of the Obama administration, as John just reminded us. At the same time, climate change is an emergency and the situation is getting worse, not better. So it's a race against time. I mean, I suspect I know your answer, but how optimistic can we be that we will win that race? Even so we're making progress, isn't the progress too slow compared with the urgency of what's happening on the planet?
Well, I think you saw the ambition level that we had as federal government of exiting coal was now ruled by our constitutional court as not sufficient. So our own constitutional court asked us to increase the ambition level of our exiting fossil fuel program and going to net zero quicker. So we moved ahead in the goal and target line to move from 2050 to 2045. And that will give one answer to the carbon pricing question, namely, we will probably have to increase prices quicker than anticipated so far. So I think that's something that we're all going to be faced with because of course, on the other side, you absolutely have to make sure that the democratic consensus still supports what we're doing. So in that sense, I think that is of course, fine line of the burden that you impose on society by increasing energy costs all has to be socially compatible and acceptable to the majority of voters. So I think that of course is a fine balance, but as we've seen, that doesn't deter us from very broad and very ambitious decisions, especially in leaving fossil fuels quicker than anticipated.
Thanks, and thanks especially for reminding us indeed of this, of the complexity and the delicacy of that balance. The German Constitutional Court ruling was quite striking, and I think reminding us of this interplay between the law, constitution, civil society, and the politics and other aspects that are constraining the response is a great way to conclude this unfinished discussion. I want to thank very warmly our two speakers for their candor. I think we went way beyond the usual platitudes on these issues, and thank you to both of you for that. I will. So this session is adjourned. We'll have the next one on June 9. We'll discuss cross-border capital flows and how to measure them. So that will be particularly in the context of the bilateral US-China relationship. But in the meantime, let me thank once again John Morton, Climate Counselor at the US Treasury, and Jörg Kukies, State Secretary at the German Federal Finance Ministry. Thanks very much and have a great rest of your day.
Thank you.
Thank you. Thank you.